And welcome, listeners, to FNC's Morning View. Today we're talking about a new book that's out. You want to tell us about it?
It's an interesting book.
One of our clients, former clients.
One of our former clients. It's a book that you and I both happened to read this weekend. It's called The Lost Bank. It's about Washington Mutual. It's written by Kirsten, who at that time, for many years, worked for a Portland newspaper and covered Washington Mutual, and now she works for the Wall Street Journal. But fascinating book, chronicling the rise of Washington Mutual from a small regional bank all the way up to, at one point, the largest mortgage lender in the U.S.
I feel like I've lived that book.
Oh, I know. And then its decline. It is an extraordinary story.
Well, let's talk a little about the rise of Washington Mutual, the availability of capital, and how acquisitions came about. But really, the book begins with the previous CEO, Pepper, having to step in and resurrect the bank from the missteps of the late 70s, early 80s.
Right. And basically, he instituted a lot of values into that bank, something he was very proud of. Making it a very customer-focused, very friendly bank, supportive of their clientele, and took it up to the point where it was a good, healthy regional bank,
making money,
and then brought in some new management and. Kerry Kellinger basically took that bank from being that small regional bank to the largest mortgage lender in the U.S.
Over $300 billion in assets.
Exactly. And he did that primarily by acquisitions. Did some organic growth.
Amundsen, Great Western, a lot of big S&Ls on the West Coast.
Exactly.
And then Homeside,
right.
The Dime Savings Bank, a lot of S&L acquisitions.
And by doing that, just grew that thing to such a large size. And you couldn't help but think through, as you read that maybe it just got too big for the management.
Maybe the systems weren't so integrated.
Exactly. People not only the systems, but an understanding of what it takes to run that kind of a bank.
And in addition to that, the systems being integrated, the right kind of systems, which goes to your issue of understanding what it takes to run that scale of a bank.
And and then they were seduced by the high returns that were available from some of these alternative products, to the point that they just went head over heels for the option arms, no-doc loans.
Well, if we step back a second, they amalgamated a large bank by combining many smaller banks.
Right.
And then once you do that, then you have to earn real returns. You cannot just grow by acquisition. You have to grow organically.
Right, and they, at one point, I think it said in there, they had 24 loan origination systems, as we knew well.
Exactly. and so they went to build one loan origination system known as Optus.
Right.
It was all about sales. The theory was the power of yes. If you came in, you needed some money.
Yeah, and it never worked, our piece was the only part of that ever worked.
Well, I mean, you're about Optus.
Yeah.
Well, so people, basically, the bank needed to grow organically. They needed to make loans, and they needed to continue to grow that top revenue line.
Right.
And so the way you do that is you either gather market share or you take on more and more risk, or both.
And they did both.
They did
both, but their focus continued to move toward more and more risk. And their risk came back to haunt them. Well,
that's a basic premise in finance. If you take more risk, you should get more return. But at some point in time, you've got to have...
Yeah, but there's a flip side of that.
Well, in fact, the chief credit officer at the time said, we have the power of yes, and we need to match that with the wisdom of no.
Exactly, yeah. In 2005, 25% of all of their mortgages were option arms.
That's amazing.
Okay, and those option arms, what was really extraordinary to me, and I hadn't realized, is that if the borrower chose to take the option to pay less than the interest.
They just added it back, basically.
They added it back, but it showed as an increase in revenue or on the balance sheet.
Because of the accounting rules.
Right.
Which is amazing, because basically it was a negatively amortizing loan.
Right.
Because they were paying less. And then when people lost their jobs and that sort of thing, it went way out of sight. And to couple that with, so you talk about leverage on leverage on leverage. Right. You had people paying less than the amount they agreed to. They were adding that back, so the loans were negatively amortizing.
Right.
Then you had, as a result of that, the balance on that outstanding loan getting bigger, the unpaid balance getting bigger. And when people lost their jobs, they couldn't pay anything. And then you had a declining real estate market, so it got the deficit on that mortgage got bigger quicker.
Exactly. In 2005, half of WAMU option arms were negative amortizing. Which is just extraordinary. I mean, they had to realize. I mean,
as long as the market's going up, it's a good gig. Okay, it's a good gig. Okay, as long as everybody's got jobs, and it's all good. It's all a good gig. Okay,
yeah.
I mean, we saw the same thing at Golden West, Savings, right? We saw essentially the same thing.
New Century, Option One, AmeriQuest, Golden West, IndyMac. Doing the same thing.
And so then as they began to move down the risk spectrum, they needed a subprime lender, so they went out and bought a Long Beach mortgage.
Right, and that caused all sorts of grief. Several times in the history of their relationship with Long Beach, they basically came to the realization that many of those loans were fraudulent. There were major problems, documentation problems. There was no records.
But the safety net was increasing property values.
Exactly.
And as long as property values are going up, and you can bail out of that thing if you have to, as an institution, and get your money back, when prices are going up of the underlying asset, you're going to be okay.
Yeah, although the investors were starting to get pretty concerned way back when, about how many losses. Long Beach consistently had the worst ratings of any of the securities that were being generated. And there was just massive evidence that things were not going right. They would clean it up, and then it would get bad again. They'd clean it up, and then get bad again.
Well, you got some notes. You going to give us some facts?
Well, it's just interesting. At one point...
Okay, I don't want to be confused with that. Okay, I don't want to be confused with facts, but that's okay. Go ahead.
At one point, half of all the subprime loans that they were generating were stated income. 70% of the option arms were stated income, and 90% of the home equity loans were stated income.
So if I were a home equity, I just wanted to say, I'll make X and I'll give you some money.
Exactly.
What a deal.
Isn't that nice? Except that
you have to pay it back.
Some people didn't tell the truth.
Well, hey, okay. But if you have no intention of paying it back, what you sell the application is irrelevant.
Yeah, exactly.
It's irrelevant.
And the amount and the reason they did this, of course, is to keep that revenue increasing.
Absolutely.
They would make on an option arm 109 basis points, and then compare that to a 30-year fix where they would make 19 basis points.
So it was like nothing compared to a bunch.
And then a subprime, they'd make 150 basis points.
Well, let's just do subprime and be done with it.
Yeah, exactly. Well, that's what they did. I mean,
but it was a pricing issue, it was a reserve issue, and in terms of underwriting, the underwriters became salespeople. Awesome.
Everybody became a salesperson.
Awesome.
And
if you had no controls,
no controls. I mean, the risk people were put under the sales. Everything was basically focused on sales. And then senior management, basically, as things were starting to get bad, starting to go south, they basically did not want to hear any negative. They just wanted to isolate themselves from the whole issue and just kept talking about how great it was, and let's go further. At one point, when things were going really far down, they were talking about buying AmeriQuest. AmeriQuest was trying to get out of the business, trying to sell the thing, and Washington Mutual was seriously talking about buying it.
Well, having said all that, all the risk people becoming salespeople took the checks and balances off. In a financial institution, you have the lending side and you have the credit or risk function, which is a check and balance on the lending side. So you want to say yes, you just want to say yes to good loans.
Exactly. You want to have some type of control. The problem is those good loans may not be as plentiful as all the bad loans.
And they may not be as profitable either.
Exactly.
I mean, if you think about risk and return, theoretically, if you take more risk, you should get more return. And so an institution should have the appropriate controls in place if they want to take more risk to be able to do that. It's just they have to have some controls in place.
Right.
As opposed to everybody turning them off and saying, we're going to take all comers.
Well, maybe one of these days in the future we'll talk about some of those controls they could put on.
Well, if you knew that as a borrower, okay, you had no intention to repay, that would be your lender of choice.
Yeah, unfortunately, there were a lot of people who just simply didn't understand those option arms, got in way over their head, and just destroyed their lives.
And because it was the first time they had to own a home. And there were several stories that were documented. In fact, there was one loan officer that made, I believe, over 2,000 loans in a year.
Right, 2,300 Ramirez in Southern California, 2,300 loans in 1 year. Can you believe that?
That is selling.
Yeah, I guess
I
so.
mean, selling.
And so obviously he didn't spend a lot of time with each one.
With documenting or underwriting.
Or communicating to the borrower what they were getting.
So, having said all of that, we, the American taxpayers, basically, do we have to pick up anything or not?
Oh, just a little bit.
Well, a little bit. But the FDIC fund got away in terms of no losses, basically, because of the way they packaged that deal on the back end. JP Morgan Chase came in, and essentially it was a prepackaged deal with the FDIC, and that was good essentially for everybody except WAMU shareholders.
WAMU shareholders and a lot of
WAMU employees, right. Borrowers and a lot of WAMU employees.
Exactly, yeah.
Who were...
It's very sad.
It is sad. So, having said all that, it's a great book, The Lost Bank. Highly recommend it to you for reading. Bob, you have anything else you want to say?
I'm done for today.
Done for today. So am I. This is FNC's Morning View. I'm Bill Rayburn with Bob Dorsey. You all have a fantastic day.